Well, good evening and welcome to this live stream coming to you from the UK, but sending it down to Australia on the 10th of October 2023. It's Martin North here from Digital Finance Analytics. Great to have you on the show tonight. And we're going to spend a bit of time this evening just walking through some of my latest analysis, specifically around mortgage stress and financial stress more generally. But as normal, I'm going to structure the show in three sections. I'm going to talk through some broader slides first to give you some context. Secondly, I'm going to go through the stress summary. And thirdly, if there's an interest, we can look at some individual postcodes by way of examples. And just before I start, I will, of course, remind you, as I always do, that we don't provide specific financial or legal or property advice. This is a general conversation only. This is also moderated in the chat, but feel free to throw your comments and questions in. Just bear in mind that we do moderate the chat. This is as at the 10th of October 2023 if you're watching in replay. And if you'd like to ask a question or get my attention, if you use @WalkTheWorld, then that immediately gets it into my queue, so I've got a greater chance of seeing it. Of course, there's a lot of conversation in the chat that I won't necessarily be able to get to, so that's a good way of making sure that I see your question. And I've also enabled Super Chat, which means that if you're interested in making a contribution to what we do here, you can do that, or indeed get your question to the top of the list. So there you go, that's the story. And what I want to do now is to go through some general slides just to give you a bit of context as to what's going on. Before I do, I just want to comment on the fact that I'm very concerned about the amount of violence around the place. A lot of people, of course, being hit left, right and centre at the moment, and so our thoughts go out to all those who are in distress. And unfortunately, the current climate around the world is one of severe distress, so that's a concern I have, feeling of helplessness perhaps, but also a concern for those who are being hit over the head. Anyway, let me go forward and start talking about some of the information that I have. And I think I want to start with this slide. This is actually from Bloomberg today. It made the point that the financial conditions are now the tightest in 12 months. I think this is a very important point because, of course, we do have a lot of pressure, higher interest rates, all of those things. And we also have a tightening of credit. And, of course, we also have some of the broader political instability, for example, in the US and other places too. So I think it's interesting to see that overall the conditions are tighter than they've been for 12 months. Now, that is an important observation, specifically as it relates to where share prices might be going, but it also has a relevance to bond prices. And talking about bond prices, of course, we saw a run-up in bond prices. This is the Aussie 2-year. And then we saw it come back down a bit of a move up. Now, there's an interesting debate at the moment about whether, in fact, bond prices have peaked and whether we're going to see bond prices now beginning to slide down a little, or whether they're going to stay higher for longer. And that an observation, I think it's not just driven by what central banks have been doing with regard to lifting interest rates, but the risk premium now that bond holders are thinking about, particularly, of course, with the US Treasury and what's going on there, and the uncertainty with regard to the speaker and the funding. And I think it's true in other places too, because, of course, the US bond market is by far the biggest, and that influences a lot of other. But it's worth noting that in Australia, the interest rates have tipped down a little, but still the bond markets are significantly higher than they were previously. And generally, my view is that we're going to see still extended rates for longer. Although there may be a bit of an easing, and if there is a bit of an easing, maybe equities will bounce a little in the short term, but I'm not sure whether it's going to be able to maintain it. Nevertheless, if you look at the interbank implied yield curve in Australia, then the markets are saying they expect interest rates to be higher, certainly for the next few months. And if you go forward to March 2025, there's an expectation that we might just be below the current cash rate by then. But what that means is through 2024, you've got to expect higher for longer interest rates. And higher for longer essentially means that we're going to see a lot of people, I think, struggling with some of the difficulties, because, of course, a lot of people took mortgages on the expectation that, in fact, rates would stay higher for a little while, but perhaps will come down, or indeed before that, the rates were in ultra low levels and there would be no interest rate rise. Mr. Lowe, of course, deceived quite a few people, deliberately or not, and so people got in over their heads. And so we're seeing this in some of the data now. And of course, the consequences are quite significant. And here's an interesting chart to show you how the outstanding mortgage rates have moved. This is a weighted average. And I find it interesting that if you compare Australian mortgage rates with the UK or the New Zealand or the US, in fact, our rates have moved up considerably higher. Now, that's a combination of the fact that we've got more variable rates in the system, the fact that we were very, very low in terms of initial rates. But the truth is that the mortgage rate increases in Australia are quite significant. And we're leading the pack, unfortunately. And there are some consequences. This is from CanStar. They said that about 31% of respondents felt confident they could continue to make repayments if there was another rate hike. Or in other words, 2/3 of mortgage holders don't feel that they'll be able to cope with another interest rate rise. That's a big deal, but it's consistent with what I'm seeing in my numbers. Now, the RBA recently disclosed some information with regard to households and household income. This is actually from the ABS, from CBA and Macrobond, and it shows there that whilst there has been some improvement in terms of labour income, and of course there was a big spike in non-labour income through COVID, because of the amount of tax being paid and because of the prices of things net, including interest rates, people are going backwards. And so there the middle line is showing the real household disposable income. So it's continuing to go backwards, and maybe not quite at the same rate of knots, but still pretty high. And what that means is that for many households, real incomes are now about 5% lower than where they were even a couple of years ago. And if you go back further than that, there are many households who've actually got disposable income which is lower now than it was back in 2012. So real incomes are under huge pressure. And of course, if you believe that we're going to see significant rate cuts very soon, which is what a lot of people were holding on to, then the concept would be that people can hold on and wait for rates to drop. But because of this higher for longer problem with inflation, and therefore with interest rates, more households now are getting to the realization that actually this is now a changed environment, and an environment which is not going to correct itself within the next 12 to 18 months. And that is a big revelation for many households in my surveys, and it does beg a whole bunch of questions about what people should do. And in fact, in the financial stability reports, there's been some quite interesting information coming out, which I'll touch on. But this is the other one that's really important. This is from Bond Advisor. And we're starting to see now the 30-day delinquency rates by vintage tick up for more recent loans, particularly in 21 and 22. Now, there is a disconnect, of course, between delinquency and stress, as we'll discuss a bit later. But for me, this is a very important leading indicator of what's happening. And my expectations is we're going to see some significant rate pressure translating to higher delinquencies ahead. And I've got some data on that. Now, this is the Financial Stability Report, or the Statement of Monetary Policy, that came out. And they made the point that if you use the HEM, the Household Expenditure Measure, then we've got more people now with costs of living exceeding income. And in fact, if you take the broader HEM, which is essentially, a pretty tight cost of living, not much in the way of fancy spending, Or if you take the baseline HEM, which is the one that in fact the banks are using, but of course that's an unrealistically low level expenditure, what it shows you is more households, but particularly variable rate owner-occupiers, are now under pressure. Here's another way of looking at the same data. About 40% of households have less than 3 months capacity to deal with this. Or another way to look at it, there's a proportion of households that have less than 3 months liquid assets to be able to actually support their mortgages. There are others that are doing very well. And once again, it shows you that there's a significant split going on between different types of households. Now, let me also highlight this population question. Of course, I keep talking about the fact we've got very high migration and the massive change, 600,000 or give or take, is creating a huge amount of pressure. And of course, a lot of people, when they come into Australia, go into the rental sector. This was data that was shown recently showing that the median asking rent has shot through the roof. So typically $720 for a house, $680 for a unit. But of course it varies by location, and in some locations it's a lot higher than that. And it's worth translating that into the significant hike in rents. So if you look at the rent in the monthly CPI, it's sitting at about 6% annualized. But if you look at the CoreLogic advertised rents, that's new rents rather than existing rents as included, then we're well above 10%. So potentially we will see more CPI increases because of the rentals. And not surprisingly, therefore, the rental vacancy rates are extremely low. This is from CoreLogic, and it shows that the combined capitals are well below the average of 10 years and continuing to drop. So rental vacancy rates very low, and as I discussed with Edwin yesterday, we've seen listings continue to fall. Now, in the more recent analysis that was done by the RBA, they went back to Hilda data. This is data from 2021, so it's extremely old. But what's fascinating about this, and it's consistent with my analysis, is that those who are renting have significantly more pressure relative to those who are owning outright or with mortgages. Remember that in 2021, mortgages were considerably lower than they are today. So this is a very, very out-of-date series. The Hilda data, unfortunately, whilst it's quite rich, is also very delayed. So it doesn't tell us much, but what you can conclude from here is that renters are in the front line. Now, consumer confidence did tick up very slightly over the last week, according to Roy Morgan, but only a tad, and we are still at levels, well, we saw them through COVID, but levels we've not seen before that. So households are really up against it now. Now, I want to talk about two other quick things too. The first is that this is a data point from the US, and it shows you that in the US, the small business survey over there shows that the average rate being paid on short-term loans has accelerated considerably. And the reason I've shown the US is because there's not a huge amount of information available in the UK. That said, I do have data in my SME surveys, and I'm seeing very similar things. So a lot of small businesses are seeing considerable rises in the interest rates that they're paying on their business loans, particularly unsecured. And of course, quite a few of those businesses are already still struggling and are also, in some cases, in hock to the bank because they've put their property on the line. And so some of the delinquencies and defaults that we're seeing at the moment are not from those first-time buyers or indeed those mortgage holders, but from the SME sector who are really struggling. And it's interesting to note that according to my analysis, we are seeing a lot of pressure, particularly from the construction sector, where a lot of small businesses have gone to the wall. Some of the highest default rates, of course, there as well. And so the first wave of defaults we're seeing are relating to small business, and specifically through COVID, where they got some limited support, but that's gone away now, higher interest rates. But it's my hypothesis that we're going to see now levels of delinquency start to rise for ordinary households. But that's going to take another year or so to show, because people can muddle through for a few months, hoping for the best. And of course, the banks are also extending and pretending. So they are actually offering people extended loans, interest-only loans, or indeed the ability to pull equity out if they've got equity on the property, enough equity to cover the mortgage repayments over the next 12 months or even 18 months, which gives the banks a bit of wriggle room, maybe households a bit of wriggle room, but nevertheless, the fact is that quite often households are actually making decisions that probably are not in their long-term interests on the expectation that either their increase in rates will be reversed, which I've discussed earlier may not happen, but also they're hopeful that incomes in real terms might start to rise. But given what we know about inflation, particularly oil and some of the other inflationary drivers, and also the wages growth is easing back rather than growing at the moment, my belief is that real wages growth is going to stay very, very benign for a long period of time, which is going to put more pressure on households. Now, there's one other slide I wanted to share, and it's this one, just to highlight how much government net debt, this is state government net debt we have, and of course Victoria leads the prize there, 168 billion, thanks to their policies. New South Wales not far behind, Queensland there too, and the other states and territories. This is a big deal now because, of course, the interest rates on a lot of this debt are going to rise. And what that actually means is that the costs of servicing debt, whether you're a household, whether you're a state, or whether you're a federal government, is actually going to continue to find significant pressure on budgets. And if you think about where interest rates were and where they now are, and how much that relates to, in many cases, mortgages have now, in real terms, doubled in terms of the payments for many people. It's true also that the costs of debt are much higher. And so states and the federal government around the world, and of course in Australia, are going to really struggle with this. And it means they've got less disposable income to spend on things and services unless they put taxes up or find other ways to cut costs. And of course in the UK we've got the same issue in there. We've got some cities that are now, well, declare themselves bankrupt, like Birmingham, for example, or others where they're really struggling to square the circle. So this is a really significant deal. But as I say, interest rates probably higher for longer, in my view. So let's now move on and talk a little bit about my latest analysis. Those of you who've watched the show before will be aware that I survey households on a continuous basis. There's a whole research universe that supports that and a core market model. And we get the data back each week and we update it each month. We can also slice and dice the data, of course, as you'll be aware. And we can also make some estimates of where things might go based on scenarios, where we think rates might go ahead. And that gives us a view of where things might end up. But of course, as with any of those scenarios, it's only an estimate. Now, the core market model powers our price scenarios. So we look at stress, the price trajectory, the buying and selling intentions. We take migration into account, as well as the broader economic and other information. Put in the core market model, and that allows us then at a state or even at a region or at a postcode level to be able to come up with some scenarios. Now, these scenarios are more conservative than we're seeing with house prices at the moment. We'll talk a bit about why that is, but I do believe that a number of people are still piling in without really understanding the implications of what's going to go on over the next few months. Now, just in passing, I do still provide my one-to-one conversations, and that means that if you want to have an individual confidential discussion with me about a particular suburb or postcode and look at some of the underlying trends, I can do that. We can look at stress, home price, data and other bits. It's not financial advice, it's just using my analysis. And it takes about an hour to have this conversation, but there's work to be done to prepare for it, which means there's a cost. And at the moment, we're booking 3 to 5 weeks out because there are quite a few people who want to have some discussions about what's going on. But if you're interested, go to the blog, the DFA blog, and you can send me a message and we can put that in the diary. Now let's talk about stress. Once again, I, of course, use my cash flow definition. There are others out there talking about things like 30% of income or taxable income or some underwriting metrics. Roy Morgan, for example, uses sort of underwriting metrics, and they're talking about maybe 1.5 million households in difficulty. I've got a bigger number than that. But we look at it in cash flow terms. And that means that if households have more outgoings, excluding one-off discretionary items than income, then they're stressed. If they have a mortgage, they're in mortgage stress. If renting, they have rental stress. And investors with cash flow pressures are also identified. They're stressed investors. And we can aggregate the data to total financial stress as well. And we express each as a percentage of households and a count. And as I've described this before, the latter, the count, is a better measure in my view because it gives you the big numbers. You can have a very small number of households in a particular postcode that could be stressed. Doesn't mean much, but if you have a lot of households, big numbers, then it can have a significant impact more broadly. Now here is the mortgage stress data for September 2023, and the first thing to note is that the mortgage stress, the yellow line, has tipped above 50%. 50.1% of those with a mortgage are now having cash flow issues. 50%. And you can see there that's gone up dramatically compared with February 2020 when it was 32.9. That's before COVID. So you can see there that we had the run up post-COVID and we're continuing to accelerate. Unfortunately, rental stress is also very high, in fact, in line with the statement of monetary policy. The truth is that renters are more exposed, and so we've got pretty much 70% of renters struggling. And the latest data from the RBA on household debt income ratios shows that they're still very extended at 186. It came back very slightly, but remember that this understates the situation because they include all households whether they have debt or not, and small businesses. So the truth is you have to multiply it by about 3 because 1/3 of households effectively have a mortgage. So what that means is that the typical debt to income ratio for a mortgage holder is 5 or 6, particularly with new mortgages. If we then look at the summary information in a bit more detail, what we can see there is that the mortgage stress, and by the way, here if it's in yellow, it's gone up from last month. If it's marked in blue, it's dropped a bit from last month. So you can see here that the mortgage stress in the ACT, in New South Wales, in South Australia and Victoria have all risen. So we're at 50.9. There was a slight slide in WA, Tasmania, Queensland and the Northern Territories. In terms of rental stress, we can see there that the Tasmanian situation continues to get worse, as in the Northern Territory. There was a little bit of easing in some other places. Now, there's 2 reasons for that. One is there were some pay rises, particularly low-paid workers, which helped a little bit. And also some people in rented accommodation have shifted to cheaper accommodation to try and get by. So that's one of the reasons why those numbers came back very slightly. Looking at the stressed investors, you can see there that the Northern Territory and Queensland and Victoria, stress went up. About 22% of those with investment properties are struggling. Many of them are listing and trying to sell their property. And overall, the aggregated financial stress shows it's gone up in the ACT, in New South Wales, in the NT, in South Australia and in Victoria. It came back slightly in Queensland, Western Australia. And the overall financial stress eased just slightly, but still at 48, which translates into 4.7 million households. And just to underscore that, we have 1.9 million in mortgage stress, 2.1 million in rental stress, and around 642,000 property investors in difficulty. Now, let's look at it another way, and this is just by segments. And here I've just highlighted the big numbers rather than the changes from last month because there's a consistency about this. Young growing families, of course, first-time buyers are often the most stressed, 91% now. That means 305,000 young growing families are in significant difficulty at the moment. We've also got a lot of people on the urban fringe, the battling urban, 140,000, and the disadvantaged fringe with 518,000, not quite so high, but a considerable number. And in fact, if you look down the list there, the disadvantaged fringe, that's sort of the outskirts of town, are where the biggest absolute number live, but also highlight the point that mature stable families and suburban mainstream households are also being affected now. Looking at rental stress, multicultural establishment, those are the first generation Australians, those coming in, new migrants, are the ones at the top of the list with 78% in difficulty. That's more than 182,000. We've also got a lot of young affluence, people with big incomes, but also big rents. They're struggling, and quite a few others too, including the large numbers in the urban fringe. Looking at stressed investors, we see there that young affluents and the exclusive professionals, they're the more wealthy households, are the ones with the biggest proportion of problems on their investment properties. Not surprising, because they've got more investment properties to start with, of course. And what this means is that we have a number of those that are actually now trying to sell. 92,000 of the exclusive professionals are looking to perhaps get shot of investment properties, and around 86,000 of those who are young affluents. But also make the point that even the suburban mainstream, some of those are also looking to perhaps get shot of property too. So one of the things we're going to see is more investment property listed ahead. And then finally, financial stress, the battling urban at 59% and the young growing families at 70% are the two largest percentages. Quickly then, I'm just going to go down and share with you the top postcodes. There have been a few changes, but not major changes from last month, so it's worth just going through this relatively quickly. But you can see there that Liverpool is sitting at the top of the list, 2170, with 92% of households there in mortgage stress, and that includes Chipping Norton and Warwick Farm and quite a large area. Then we go to Campbelltown again in New South Wales, and then we go to Western Australian postcode 6065, which includes Tapping, then to Toowoomba, then to Hoppers Crossing and Tarnit in Victoria, then Roxburgh Park, Donnybrook. And these outer suburban areas in Victoria really come up, of course, again and again. Then we have Pakenham, similar. Then we cross to Western Australia in the Samson area and places like Spearwood, Lake O'Connor, North Lake. Then we go to Camden in New South Wales, Berwick and Harkaway in Victoria, Cranbourne in Victoria, Ballarat, of course, regional Australia, and then Riverstone, which includes Marsden Park and Vineyard and places like that in New South Wales. And we'll make the point that when we say 100% here, it's a bit estimated because it's plus or minus a couple of percent. So it might not be everybody, but it's most people are in cash flow pressure. If we then look at the rental stress, you can see the centre of Melbourne is still there at the top, then Toowoomba, then Liverpool, then up in Queensland, Southport and Labrador, then Hoppers Crossing and Tarnit, then Wentworthville and Zetland and Campbelltown in New South Wales and Mount Druitt. And then we have some Queensland postcodes and Mount Warren Park and places like that. And then Ipswich. Then we have Victorian postcode Point Cook and Derrimut. A lot of investment properties there, of course, are being rented by newly migrated migrants. And then we go to Blacktown, Parramatta, and then Bundaberg. We then move to the next one. This is now stressed investors. So this is the yin and the yang. Centre of Melbourne, of course, a lot of stressed investors there. A lot of them sitting around Docklands, by the way. Then we go to Western Australian postcode 6010, including Swanbourne. Then we go to the Happy Valley in Queensland, then Bundaberg, Cranbourne, Wentworthville, then Southport again, then Kellyville, Fortitude Valley, and Surfers Paradise, and then Samson, Highgate Hill, Coomera, Parramatta, and St Kilda. They're the top ones. And finally, financial stress, which starts with Toowoomba. So Toowoomba unfortunately holds the prize with more than 26,900 households in financial stress, at 57% of all households in that area. Then we go to Liverpool with 69%. Then we go to Campbelltown with 78%. Then Hoppers Crossing and Tarnit. Then centre of Melbourne, Cranbourne, Point Cook and Derrimut and Werribee, Craigieburn, and then Mount Druitt and areas around there. Areas around Ballarat, then Belwood Park, Launceston comes in. We're seeing a lot of stress in the Tasmanian context. Unfortunately, incomes there have gone sideways or worse. And of course, prices have risen dramatically over the last couple of years. Then Ipswich, then we go to Blacktown, Samson in Western Australia, Wentworthville and Tapping. So you can see that there is a consistent pattern. And as I said before, a lot of these postcodes are actually those high growth corridors where there's been a lot of development, a lot of homeland packages, a lot of people who bought off the plan, a lot of people who took mortgages out 2 or 3 years ago when interest rates were really low, and they were encouraged by the government to grab those properties. Now they're actually finding that it's really tough. And interestingly, in my data, what I'm seeing is more households in these areas are working multiple jobs, trying to work more hours, trying to actually do anything to get by. But of course, the difficulty is that these pressures build again and again. So we are seeing an increase in use of credit cards, an increase in buy now, pay later, and a lot of pressure, a lot of difficulty on households in these areas. Okay, now we briefly talk about our scenarios. So this is a way of just talking about the different futures that we have. And here is our scenarios. Just to say this is not a prediction, it's just a way of sensitizing the model for different things today. They run forward from today. And I've got 3 scenarios. The first one is what I call the Goldilocks zone. So rates don't go up, they stay at 4.1 and they fall sometime later next year. Inflation eases in line or ahead of RBA expectations and wages rise faster, and we managed to escape a recession in Australia. I guess that's the most hoped for one. The RBA is sort of, signalling that they may have to put rates up higher. The markets are believing that they may, but there are people who hold this view that in fact rates won't go up higher now. There's another view, which I call my soft landing view, that rates do go up a bit more, up to 4.35%, which will give you mortgage rates of 6.75 to 7.5%. They stay high through 23 and into 2024, and inflation stays above target until 2025, but there's no recession in Australia, and rates eventually do come down later next year or into the following year. And the worst case scenario is the nightmare scenario, where because of the international situation, because of the fact that oil prices continue to rise, we've got the rates go higher than 4.35%. And of course, there are some economists predicting another 2%, another 0.25% rises, so 0.5% from where we are, so 4.1 at the moment. Mortgage rates will be higher at 7.5%. They stay high into 24. We see inflation still sticky. Wage growth then stalls due to the recession, and then they cut rates quite dramatically. But of course, it's too little, too late. And of course, we can then plug those into our core market model. This is an example from earlier in the year, just to show you how the scenarios play out, where in fact you can see that as stress builds, we tend to see falls in prices. But we'll come back to that in a little while. Because what I want to do now is just to flip across and show you some of the information that we've got from our mapping, because the mapping, of course, as I think I've shown you before, is actually quite powerful when it comes to looking at where the problems are and how it maps through. So we're going to start with this map, which is the area in and around Sydney. And as normal, what I'm doing here is mapping the mortgage stress counts. So the more orange and red they are, the more pressurized they are. And in and around the centre of Sydney, well, there are a few counts there. Like Mossman, there's a few for Vaucluse, Northern Bondi, areas where perhaps you would expect people to be hanging in quite well, but there are other areas where things are pretty good, down in the blue area. But if you then pull out, you start to see, of course, as I've shown you before, but I'll continue to show, the pressurizing that's building particularly out in the west. And the thing about the west is that it's a big area with lots of households. So the counts rise as we move out. And you can see there that what you start to see are these big areas in and around, so there's Blacktown, of course, Campbelltown, Liverpool, Camden, those areas. And as we pull out, you can see there the ring of fire in the west, which is really quite concerning. And if we pull out a little further, it's the same story. And you can see there that even, round from the north, round to the south, Western Sydney is where a lot of the pressures are. And that's one of the reasons why, if you look carefully at what's happening with house prices, whilst there are some areas where prices are still moving up quite fast, there are other areas, particularly in some of the western areas, where the price growth has been nothing like what you might expect. We're seeing more listings coming on, and we're seeing more pressure. Now, if I then go to another postcode, we'll just go to, let's go to 4,000 just for the sake of it. Whoops. So this is now in and around Brisbane. And once again, you can see the same story where in and around the centre of Brisbane, things don't look too bad. But as you pull out, you start to see the similar problems with the orangey colours coming in. So Camp Hill, for example, is one example, and Aspley and G-Bug to the north. And then you see, as we move out further, the Ipswich area, of course, continues to be a concern, as I discussed and showed. And as we pull out, we can also see that Toowoomba's on the list there as well. And in fact, if you look down on the Gold Coast or the Sunshine Coast, there are some pressure points there. But again, there are some areas where it's pretty significant. Now, I'm just going across now to 6,000. And again, you see a somewhat similar story where some areas in and around the centre of Perth are doing reasonably well. And maybe that's not too surprising. The incomes are higher and the prices of property are still there, extended, not quite as extended as they were some years ago. But if you pull out further, then you start to see the same old, where stress builds. And as you look south and north, like Wanneroo to the north, for example, and Coburn to the south. And you can see these coastal areas where there's considerable pressure, and also quite a few postcodes to the south of Perth there. And if you come down to places like Rockingham, there's a bit of a problem. Now, of course, there may be some demand because of the new submarine bases that they're talking about, but nevertheless, you can see that's a bit of a problem there. So that's the story with mortgage stress. I could do the same with rental stress, but I won't at the moment. But what I will do is just show you another one, because what I want to do is to show you the default mapping. Now, this is an attempt to try and model what's going on with default. So this is the percentage of households that are expected over the next year to be 30-day delinquent. In other words, they miss a payment on their mortgage. And you can see here that in and around Sydney, it's not particularly bad, but there are a number of areas where we're talking 2 to 3, 3 to 4% of households are likely to miss a payment. And what I find interesting is that the missing the payments is actually more centred on the areas in and around Sydney relative to the western suburbs, which I find very interesting, and that's to do with the overall cash flow that households have. Now, if we were to do something similar over in Western Australia, what I think is interesting that we are seeing more pressure in the west. And so as you pull out, you can see there that the delinquency rates are, in this area here, in Claremont and places like that, are actually quite high. In Northern Beaches as well, you can start to see some pressure. So whilst the story of mortgage stress is a little easier in the West, the modelling shows me that delinquencies in the West are potentially somewhat more concerning. And there are areas where we're seeing quite a lot of households in some difficulty. Now, I could spend a lot of time on the mapping. I'm not going to today because I think that's given you a bit of a flavour. But my point is that there's not a direct line of sight between mortgage stress and delinquency. One, there's a timing question. It can take 18 months to 3 years. The other is that there are things that people can do to try and actually relieve the pressure of mortgage stress, including, as I've explained, refinance or indeed decide to sell the property. But where things have got a bit ingrained, like in Western Australia, because there the peak in prices were some years ago. And so what we've actually got is we've got delinquency building, not from the more recent purchases, but from the older purchases. And it shows you that there's a longevity question. How long does it take for households to actually fall off the cliff? And it's just worth noting that in the global financial crisis in the US, the peak was 2007, 2008, but the peak of delinquencies was 2012, 2013. So it takes time for this to work through. Now, if you then believe that we're going to see rates come back down again, and quite quickly, then there's a chance that some of this mortgage stress could get reversed later. But the higher for longer mantra that we're starting to see now suggests to me that it's more unlikely that we're going to see rates come down. We're going to see inflation still embedded and running quite fast, which means I think that the proportion of households who are going to be in difficulty will continue to muddle along at these high levels. And the point there is that we know households are actually spending less on discretionary spending. Their absolute dollar is going up slightly because they're having to spend more on the necessities because inflation's driving them higher. But it means they've got less capacity. And many households, as I said earlier, are also now working more hours, doing more jobs, trying to find a way to muddle through. So it's a question of to what extent will households be able to continue to muddle versus to what extent they ultimately will have to fall over. The banks, of course, will do everything they can to keep the delinquency rates low. The last thing they want to do is foreclose. The last thing they want to do is to have to put more capital against bad loans, which is one of the reasons why they're being very flexible and very accommodative at the moment. And, of course, the banks always say, talk to us if you've got a problem. That's probably right. But sometimes what the bank recommends, which could be a refinancing or restructuring, is in the interest of the bank, not necessarily in the interests of the consumer. Now, the next thing I'm going to do is I'm just going to switch over to my other view, which is actually the individual data points relating to postcodes, because I do have information down to a postcode level, and of course that's updated each month. So if I put that up here, okay, so this is the information relating to the individual postcodes, and I'm just going to talk through, for those who may not know, this is how we look at it. So this is postcode 2000. So we have information about the household count and what proportion own outright, are borrowing with a mortgage or are renting. We've got some information about the proportion and number in stress, mortgage stress, rental stress, investor stress and financial stress per my modelling. We've got some information about the particular mix of property, houses, units, other types of property, and also the people ratio. In other words, how many people on average per household. The higher, it's more likely to be a household with kids. Lower means it's an individual or a couple. The vacancy rate based on the last census data. Information about the gross and net yield. And we also have information relating to specifically the scenarios and what may happen to home prices, which is also mapped. And then very importantly, we have this information, which is the key information, which tells you about the disposable monthly income. So what proportion of disposable monthly income is going to pay the mortgage. Here it's 41.8% on average versus 38.7% on average. And that's a big deal. So it gives you a real big sense of what's going on. Now, those scenarios may not play out. You know, if demand continues to go strong, they might go higher. But it's worth noting that overall, cumulatively over the next 3 years, I'm sort of thinking that prices will be roughly sideways, best case scenario, but could fall and fall quite hard if in fact we get a recession. So it does come back to this question of recession or not. Okay, so that's pretty much setting the scene. If we would like to go and look at individual postcodes, we can do. And in fact, I see my little adventure says postcode 2110. So let's try putting that in the system. Okay. In Hunters Hill, we have just over 3,300 households in Hunters Hill. 41% own outright. So it's a very stable environment. A lot of people no mortgage at all, but 36%, 36.9 have a mortgage, 1,200. 25% are renting, and within that, for those borrowing, about 30% are in mortgage stress. So it's not massive, but a lot of renters are in rental stress, 75%. We've also got some stressed investors because, of course, that's tied into the rental story, and overall financial stress, we've got about 38.3%. Now, if we then look at the mix of property, we've got 70% of houses, 18% in units, about 11% other types of property, including over shops and other different types of property. The people ratio is 2.47, so that's a lot of families. The vacancy rate on census night was 9.2%, which was quite high. And the gross investment yield in this postcode, if you're an investor, is around 3.4% on average, but the net investment yield is minus 0.6%. And that's important to understand because minus 0.6% shows you that in real terms, accounting for the interest rate on the mortgage for an investment property and the maintenance costs, you're losing money. Now, looking specifically at the average incomes, the ATO said 229,000 versus the household census, which was 125,000. So these are pretty affluent households. But the killer here is, look at this. This is the net disposable monthly income. So it's over 52% at $5,200 for the average mortgage. That's because prices are extended, of course, in this area. Whereas the renters are around 26.9%. But the point to make is, whilst it's 52% of disposable income, because the incomes are so big, the mortgage stress, as I discussed, is actually quite small. We got there. Now here's another one, 2228, please. So let's bung that one in. 2228. Okay. So 2228 is Miranda. And I'm just going to take the chat off again so that we can see. Okay, so in Miranda, 8,400 households with 28% owning outright, 38% borrowing, 32% renting. Mortgage stress is at 31%, rental stress is at 71%. The stressed investors is somewhat higher, and the households in financial stress is 48%, so that's quite high too. 46% of houses, 36% of units. The vacancy rate was 6.7%, and the people ratio is a little lower, so there are some households with kids, others with singles and couples. Gross investment yield 3.4%, net investment yield minus 0.3%. The taxable income a lot lower in this postcode, so on average from the ATO per individual 89,000, and in the household census 104,000. But that translates to a disposable monthly income around 50% at $3,120 per month, whereas for rent it's 39.5%. And in terms of the scenarios, the best case scenario is that prices ease very slightly over the next 3 years. But of course, if things go more adverse, then prices fall quite considerably. Okay, here's another request from Justin Tech In. Varsity Lakes 4227. Okay, so this is obviously a Brisbane postcode, and here you can see there's 9,000 households, 18% own outright, 44.4% are borrowing, and 37.3% are renting. 37.7% are in mortgage stress, 52% are in rental stress, and we've got 28% investors who are stressed. Overall financial stress is 45%. Looking at the mix, 50% are houses, 70% are units, and other types of property, including over shops. And looking at the people ratio is 2.52, so it's, you know, a combination of kids and households plus solos and couples. Gross investment yield is 4.7, the net investment yield is positive 0.4, so still making a little bit of money even after all the interest rate rises. ATO says 72,000 individual tax, or 93,000 household from the census. And that translates to 41.8% of the disposable monthly income going on the mortgage at 2,340, or 43%, 2,417, going on the average rent. And looking at the scenarios, there's definitely a scenario of price rises over the next 3 years on the best case scenario, both units and houses, whereas in fact if things go more pear-shaped, then prices could fall. Okay, postcode 3131 was asked for. We'll do that one. 3131. So this is Nunawading in Victoria, in the White Horse area. 9,100 households. 33% own outright. 38.4% are borrowing, and 28% are renting. We have 14.3% in mortgage stress, that's pretty low, but the rental stress is very high, 83%. Small amount of stressed investors, and financial stress overall is about 29%. Looking at the mix of property, 70% are houses, 3.2% are units, and there's quite a lot of other types of property, including over commercial property, for example. The vacancy rate was 6.5% on census night, and the gross investment yield is 3%. The net investment yield is positive 0.4%. The ATO says that the average taxable income is 79,671. The census said household income on average 93,912, and that translates to 44.9% of disposable monthly income at $2,600, and 34%, $1,969 a month. And looking at the scenarios, best case scenario, this is cumulatively over 3 years, pretty much flat, maybe a slight rise, but obviously if prices ease back because of the broader scenarios in terms of recession and higher interest rates, then prices could fall. Okay, let's go here to Michael asks for Charleston 2290. Let's bung that in the system. Hang on, I lost my cursor. 2290. There we go. So this is Mount Hutton in the Hunter. 14,000 households, 33% own outright, 41.5% are borrowing, and 24% are renting. We see 31% in mortgage stress, 50% in rental stress, not much in the way of stressed investors, and overall stress quite low. 81% are houses, 4.9% are units, and the people ratio is 2.37%. Gross investment yield is 3.4, net investment yield, this is after all expenses and interest rates on the mortgage, minus 0.3. The taxable income from the ATO is $80,000, or $92,000 from the household level at the census. And that translates to 42.1% of disposable monthly income, or $2,392 going on the average mortgage, or 34.2% going on the average rent. And from a scenario perspective, if the best case scenario plays out, prices will be higher in 3 years' time. But if not, then prices will be lower. Okay, question here for Toowoomba 4350. So Toowoomba, of course, was top of the list. So you can see here that things are not particularly flash. 47,000 households, 28% own outright, 33% of borrowing, 38% of renting. You can also see there that 74% of borrowers with mortgage are in mortgage stress and 71% in renters are in rental stress. Some stressed investors too. The overall financial stress metric is 57% of households. That's very high, more than 26,000. 76% of houses, 5.3% of units. There's quite a lot of other types of property there too. And the people ratio is a bit lower. Vacancy was 8% on census night and 4.2% of the gross investment yield, 0.4% of net investment yield. And the taxable income, 74,000 from the ATO and 74,000 from the household census, which means that the disposable monthly income is 35.5%, $1,800, and 30%, $1,520 going on the average rent. And again, I'll make the point that, of course, it's a combination of the income level as well as the mortgage payment level. And because the income is somewhat lower here, the stress levels are a lot higher than we saw in some of the other ones. For example, in the area around Sydney, where incomes were more than $200,000. And in terms of home prices, the scenarios are most likely a slide over the next 3 years. Even the best case scenario, this is a cumulative view. And if interest rates continue to rise and we get a recession, then things get even worse. Okay, 3760. So 3760 is Kinglake in the northeast of Melbourne. Now I should say that this is a problem. This is a low count. So when the counts are so low, it's not necessarily that statistically reliable. But I'll just quickly recap it anyway. So we see there are a lot of borrowing outright, 64%, 29% own outright. There's not much renting going on. Mortgage stress is 57%, but it's a very small number, of course. And looking at this, pretty much everyone's got a house. The people ratio is 2.28. Vacancy rates were 10.5%, and the gross investment yield is 2.7. Net investment yield minus 1.9%. The ATO says that the average income is 71,000. The household census at 90,000. And looking at the disposable income, 35% going on the mortgage at just over $2,000, or 25.8% going on the average rent. And looking at the scenarios, we'd say best case scenario, there would be a rise in prices over the next 3 years, whereas if things go more pear-shaped, then there would be a fall. Okay, Middle Cove Motors says 2068 Willoughby. Yep, can do. Okay, so this is in Willoughby, and here we have 6296 households, 36% own outright, 30% of borrowing, 25% of renting, not much mortgage stress, quite a lot more rental stress at 62%, and we're seeing some financial stress, and we're also seeing financial stress overall at 36%, so high but not as high as some of them we've seen. 68% of houses, 20% of units, and there's a few other types of property too. The gross investment yield, 3.7%. Net investment yield is pretty much zero, so people aren't making much in the way of a return, other than the capital appreciation, of course. Looking at the individual ATO data, 165,000 for the average income, 168,000 for the average household in the area according to the census. And 56% going on the mortgage, 4680. 38.2% going on the average rent at 3189. And the scenarios are best case pretty much flat, a fall if things go more pear-shaped. And again, I'll highlight the point, 56.1% is a big proportion, but the incomes are a lot higher. So higher households have more flexibility than lower households in terms of navigating higher mortgage rates. Whoops. Just seeing what else we've got there. Ben Chesterman said 2077. I'm just working my way down the list, so if you've put your request in more recently, just hang with me. I'll hopefully get to it. Okay, so this is Hornsby. The count is 17,000, 21% own outright, 39% of borrowing and 40% of renting, 35% in mortgage stress, 68% in rental stress, 39% of houses, 55.9% of units. There's been a lot of development up around Hornsby, of course. And the people ratio is 2.41, so that's some households with kids as well as singles and couples. 3.5% is the gross investment yield. Net investment yield is flat. Average taxable income, 85,000. The household census number, 109,000. And looking at the disposable income, 44.1% at 2,820 for the average mortgage repayment, and 35.8% or 2,292 for the average rent. And the scenarios are that prices are likely to go sideways, or if things get more pear-shaped, are likely to fall. So here's one. Charmside 4032. High density suburb, he says. Let's have a look, shall we? 8,341 households, 20% own outright, 26% of borrowing, but 53% of renting. So a lot of renting there. 66% in mortgage stress, 60% in rental stress, some stressed investors, and 54% of households in financial stress overall. 42% of houses, 42% of units, plus other types of property. The people ratio is lower, just over 2, so that's more singles and couples than households with kids. The gross investment yield is 4.2, net investment yield is minus 1%, so underwater from a cash flow perspective. Looking at the taxable income, 73,000 from the ATO, 82,000 from the household census. And looking at those repayments, 39.7% or 2,263 going on the average mortgage repayment, and 33% going on the average rent at 1,918. And looking at the scenarios, best case would be a small rise over the next 3 years. The likelihood is a fall if things deteriorate, as I discussed in my scenarios. Okay, 3441. Okay, 3441 is Mount Macedon. It's a very low count, so got to be careful with here. 546 households, 41% own outright, 51% of borrowing, almost nobody is renting. Those who are in difficulty, but those with a mortgage, not too bad. And we see that the houses are 98.4%, almost no units. Vacancy rates were high at 15.2%, so that could be a lot of Airbnb or holiday homes there. And you can see there that the gross investment yield is around 3.5, net investment yield is minus 0.5. Looking at the income, 149,000 versus 137,000 based on the household census, giving us 38.2% of disposable income going on the mortgage repayment, 3,125, or 20% at 1,645 going on the average rent. And the scenarios are there's maybe sideways if you're lucky, but potential fall if not. And Vanessa asked, is the camera blurry? Tell me if it is. It's looking okay here, but I don't think it's a problem. Okay, here's another one. 2063. Did I do that one? I don't keep a list because it's just too complicated to do, so let's bung it in. Northbridge. No, I think maybe we did. No, I didn't. Don't think we did. 2063. This is Northbridge. Okay. 2271 households, 24% owning outright, 38% borrowing, 36.8% renting, 6.6% in mortgage stress, 62.5% in rental stress. The stress investors are at 60% and overall financial stress at 65%. And looking at the scenario, 74% are households, 19.2% are units. We've got 6% vacant and the gross investment yield is 3.5%. The net investment yield is plus 0.1%, so just positive. Incomes are pretty high at 224,000 from the ATO or 201,000 from the census data, giving us 54.3% or 5579 on the average mortgage repayment and 35.9% at 3688 on the average rent. So once again, you see this same phenomenon where in fact the incomes are higher and so they can afford to pay a higher proportion of monthly disposable income. And it's worth just stressing that these mortgaged households are seeing massive rises in their actual monthly repayments. In some cases repayments have doubled from where they were a couple of years ago, 18 months ago. So that's one of the reasons why we're seeing this scenario. But stress is still quite low, so they can manage it. Unlike some households where, of course, we had considerably lower levels of income, and whilst the disposable monthly income ratio was lower, the stress was higher. And in terms of scenarios, a bit of a fall over the next 3 years is the most likely scenario. If you believe that things are going to be okay, fall if, of course, things are going to get worse. And hello to Jason. Thank you for dropping in, Jason. Good to see you there. Okay, 7005. So this is in the inner Hobart area. And 5585 households, 40% own outright, 24.9% borrowing, 35.1% of renting. And looking at the stress, 9.1% of mortgage stress, 58.4% of renters in rental stress, a bit of stressed investors, but not a lot, and 31.8% of households overall in difficulty. 69% of houses, 16.5% of units, and some other types of property there too. People ratio is lower, so that will include some singles and individuals as well as households. 11% vacant, 5.4% gross investment yield, 1.8% net investment yield. So even after all the price rises, people are still making a bit of return, not a vast return. The ATO said 104,000 the average income, 98,000 from the census, and that gives us 40.2% as the average monthly disposable income on the mortgage, 2600, or 32.4% at 2093 on the average rent. And the scenarios are still some upside potentially over the next 3 years if things go positive, but of course if not, then there's a bit of a fall. Okay, I think I did that one, didn't I? So thank you for the super chat, appreciate it. Okay, any more? Let's have a look. Yes, here too. 3844. 3844, which is Traralgon in Latrobe. 12,824 households, 32% own outright, 42% of borrowing, so quite a large proportion mortgaged up, 24.4% renting, 80% in mortgage stress, 54% in rental stress, some stressed investors, and about half of households in financial stress. 87% are houses, 8% are units. People ratio is quite low. Vacancy rate's 8%. Gross investment yield's 3. Net investment yield minus 0.9. Taxable income 80,000 from the ATO and 80,000 from the census as well. That translates to 30% on the disposable monthly income, 1589, and 26.2% at 1380. And looking at the scenarios, a bit of a fall likely over the next 3 years because of the high levels of stress there. I expect perhaps to see some properties being forced to come on the market, but as I've explained before, it will take a bit of time to be able to work its way through. Okay, let's have a look. 3131. Did I do that one? Let's just have a quick look. 3131. I did, yeah. So that one's already done. Mount Druitt asks for. Ben says Mount Druitt. 2770. Yeah. Oh dear, this is not a good story. 19864 with 17.5% owning outright, 31% of borrowing, and 51.5 renting. They're pretty much all in mortgage stress, plus or minus. There's a lot of rental stress there, a lot of stressed investors, and overall financial stress is at 86%. 76% of houses, 10% of units. The people rate is a little high, as that includes some families, of course. The vacancy rate is 6.7% in the census. Gross investment yield is 3.4, net investment yield minus 0.3. Taxable income, on average, 63,000 from the ATO or 68,000 from the census. And that gives you 47.6% of disposable monthly income, 2160, going on the average mortgage, or 35.2% going on the average rent at 1595. And it's worth highlighting, low income, very high proportion of disposable monthly income equals high stress. And of course, as a result of that, my expectation is that prices here are likely to slide in the next 2 or 3 years. And Vanessa said, yep, it's all good. It was my YouTube app. Yeah, sometimes the YouTube drops to a lower resolution, which means that everything is blurry. So sometimes reloading and picking the highest. I stream at 1080 here at a high rate, so it should be pretty good. I am planning at some stage to upgrade to 4K. I have the facilities to do that, but I haven't yet done that, so watch this space. Okay, Sydenham 4037. 16,700 households, 26% own outright, 54% borrowing, 18% are renting. 91% are in stress for mortgage holders, 100% of rental stress. So overall stress is very high. We see 80% of houses, a very small number of units. And we see a very high people ratio, so a lot of families here as well. The gross investment yield is 3.3, net investment yield is minus 0.3. Average taxable income, 72,000 from the ATO, 106,000 from the census. And that gives us 36.3% or 2206 on the average disposable income for the mortgage, and 30.3 or 1843 for the average rent. And unfortunately, my expectation is that prices are likely to go down over the next 2 or 3 years because of these high levels of stress. And once again, I'll make the point that these are relatively low income, but high proportion going on the mortgage. So that's a reason. And just to remind everybody, if you haven't liked the post, please do so. Drew asks, which state has the most value? Interesting question. By value, do you mean from an investment perspective, which would be probably Queensland or Western Australia, or from a appreciation value? At the moment, appreciation in Queensland is probably looking more reasonable than others. Tasmania, selectively so. It does vary though by which type of property and where you look, so it's hard to give you a definitive answer for that one. Okay, 2077. So this is Hornsby. I think I've done Hornsby. If fact, I know I've done Hornsby, so look back in the replay, it should be there. 5600. Whoops, what's gone wrong there? I moved it up the page. Okay, this is in Whyalla. 2713 households with 32% owning outright, 40% borrowing, 26% renting, 10% in stress from a mortgage perspective, but 66% in rental stress. Not a lot of other stress there. 80% of houses, 5.4% of units, and the vacancy rate was 13%. Gross investment yield's 4, net investment yield 0.8. And looking at the income, 84,000 from the ATO and 80,000 from the census, giving 31% going on the average mortgage repayment and 19.8% going on the average rent. And the scenarios are price rises are possibly there over the next 3 years if we get that benign scenario, but less so if we don't. So Jerry asks, will your models include average house price and average debt per household? Well, I have some of that information in my underlying models, but it's not in the one that I'm using today. But that information does exist because I do have the mark-to-market value of every property in the model, and I also know the average debt per household, which I can then report. So if there is interest in that type of analysis, put a comment in the comments below and perhaps I'll make a show on it later. And thanks for the super chat. 2025. How are we doing for time? 10 minutes. I've got to close at around the right time tonight because I'm recording with John Adams shortly, which is going to take a bit more of my time later. So 2025 is Woollahra. 3167 households with 35% owning outright, 27% borrowing and 36% renting. Mortgage stress is quite low, but rental stress is quite a lot higher. And there are stressed investors and financial stress households too. Houses, 17.8% of houses, a lot of units, 50%, and there's other types of property there too. The people ratio is lower, so that includes individuals as well as families, of course. The vacancy is quite high with 15.2%, so some people have multiple properties, including in this more affluent area. And the gross investment yield is 3.5, net investment yield is minus 0.4. Taxable income, according to the ATO, 218,000, and it's an individual level. Census, 156,000. And looking at the mortgage repayments, 56.8% of disposable monthly income at 4,800, or 39.5 at 3,338 going on the rent. And looking at the scenarios, can't see a huge amount of capital appreciation unless things change. Okay, we'll see what we can do, Jerry. Okay, now Jason's asked, do you know if investors in stress look and say, well, I owe and I'm paying over the interest rate in a higher compliance environment costing more? Interest rates up means less equity to the bank, affects the better yield. Yeah, so it's clear to me, Jason, let me just put the main camera on for a bit. It's clear to me that a lot of investors haven't done the sums until now, but they're now doing the sums. And they're pretty shocked when they actually calculate something that is really quite surprising, which is that from a cash flow perspective, they're in negative. And when you actually incorporate all of the costs of managing the property, that includes the interest rate payments if you've got a mortgage, plus the maintenance and everything else, and the other depreciation, etc., then they're not actually making much. And of course, the capital appreciation has to be offset, because when you sell the property, you actually have to claim, you pay tax on it. So when they do all the numbers, a lot of investors are now saying, oh, can't make this work anymore. And then, of course, those extra compliance costs that you've mentioned, including in some cases, you have to have better fire alarm systems or other types of inspections, or you're obliged to take pets, all of those things. So there's a lot of investors teetering on the edge and thinking, can't make this work anymore. So it is quite weird as that's what's going on. But a lot of the property investments that are coming on are older style, where they haven't done a lot of maintenance, where the costs of getting up to scratch would be very high, and it's not just worthwhile. I'd also make the point that some of those investors are now getting to an age where they want to actually simplify their financial situation, and getting rid of the investment property is a way of simplifying it too. So that's another factor in the mix, I think. And Jason said, my super chat was removing appreciation from the equation. I caveat. Okay, fair enough. Well, hopefully that makes sense. Yeah, the CGT thing is a bit of a scary point. Many people who are property investors don't understand the CGT aspect of it, which is, of course, a big deal, particularly if they had a big appreciation. I think another point I'd make is that in some cases what we're finding is that households who thought they had a robust portfolio suddenly find that because of the costs of the interest rate have risen so much, they can put the rent so much up, but then they can't go on putting it up. So that means that economically it does not work anymore. So I think, and I reckon there's about 20% of properties that have been taken out of the investment market over the last year or so. So I reckon it's going to be an issue later. Well, we're quite close to the end of the show. I thought what I might do is just go back to finish off the conversation. So if I go there and then do that. So I always say at this point, you know, if you are somebody who is in significant difficulty with cash flow and you've got a mortgage, it's very important to get help. And whilst you can reach for the banks and they encourage you to do that, I think it's really important to get some objective advice. Now, you've got to be very cautious here, because if you're not careful, you can do a Google and find a firm who offers help but actually will charge you for it. National Debt Helpline is what I recommend, 1-800-007-007. It's obviously government backed, and this is where you can find some amazing help that's available. So if you have an issue, it's worth getting some advice, because the fact of the matter is that things are not going to cure themselves anytime soon. My perspective is simply this: interest rates are going to stay high for longer, inflation is going to stay high for longer, real income is not going to grow, and therefore there is no simple way out of this. Now, in some cases, selling could still be the best answer, or maybe you can restructure the debt. But it is worth remembering that when you talk to the bank, their interest is continuing to get you to make your repayments so that they can actually claim their mortgage is not delinquent. And so sometimes what the banks offer is a solution that isn't actually best for the household, in my view. So it's worth just getting some objective independent views, I think, as you go through that. Now, if you want some more information about all my analysis, you can go to the DFA blog. I've put the link down there. There's a lot of information in there about what I do and how I do it, and all of my shows are also put up there. I've also got my Patreon channel, and if you go across to Patreon and subscribe via Patreon, really appreciate those who help to do that. You can also get the underlying model and the information. It's $50 a month plus GST if you would like to get the full model that I've been showing tonight. And that gives you information for more than 2,000 postcodes, updated each month for as long as you maintain your subscription via Patreon. So if you want to sort of get it for a month, you can subscribe and then unsubscribe, or if you want to keep subscribing, I send it to you each month. And in fact, for those on the Patreon program, I'll be sending out the Patreon update now that I've made this show. I'll also make the point that if you'd like to support me another way, you can also make a one-off contribution via PayPal me. And again, that just helps to cover some of the costs. I don't do this to make a profit. I do it because I think there's a really, really important conversation point to be having. And I think it's pretty important that we actually have a mature conversation. And I make the point now that in the stability report, there was a bit of a conversation there about what was going on. And the fact is, we'll be seeing a lot more reference to stress and difficulty, I think, in the months ahead. Anyway, I think that's pretty much it for tonight. So I want to say thank you very much for spending time with me and listening to me chat about this mortgage stress stuff. It's something I care about a lot because I really think that households need to take ownership of this themselves. As I discussed with Steve Mickenbeck earlier in the week, the fact is that people have a significant question to ask, but there are things that can be done. Prioritizing spending, making sure you've got a cash flow, making sure that you speak to the bank if necessary, and getting independent advice from debt counselling services if you have difficulty. The thing you can't do is just put your head in the sand and say, she'll be right. Because what I'm seeing is the build-up of pressure, which means that households are going to be struggling in the weeks and months ahead. And I don't expect that interest rates are going to come down in the next few months. So it's a really tricky time. But on the other hand, if you do understand there's a problem, there are levers that can be pulled, and there are advices out there that can be thought about. Anyway, just before I go, let me just give you a bit of a flavour. This is the studio set up tonight, so I've got the chat there, I've got my screen with all the content there, the multi-view screen from the ATEM that I use to make the show work. That's the way I work. And of course the doggies, believe it or not, are still in the bed. They've been there all morning. And in fact, I can just zoom in with my PTZ camera. Whoops. Trying to do it while I'm speaking is always difficult. There you go. So there's Luna at the back and Meter at the front. And those of you on Twitter will have seen that I took them for a nice walk up Peak Hill down near Sidmouth the other day, which they loved. They took me for a walk rather than the other way around. But there you go. They are moving, so it shows you they are actually live rather than not. Finally, just to say that next week I'll be back, and I've got Dr. Cameron Murray on. We're going to talk about a bunch of things. He wrote, of course, The Game of Mates, which is the story of the way Australia does business. And we're also going to talk a little bit about some of the recent people who've exited public service and gone into the private sector and what that means. We're also going to talk a little bit about the question of the education sector and how that's accounted in the national accounts, plus, of course, some issues relating to housing. So mark your diary for next week. And the following week, I've got Robbie Barwick coming on to talk about the cash question and bank branch closures and those things like that. And the week after that, Tony Locantro is coming back to talk about the being sandpapered to death and his latest perspective. So that's the lineup for the next 2 or 3 weeks. I want to say thanks very much for your spending time with me this evening. Remember, Cameron is next week. Great guest, worth coming on to hear him. Check out our recorded shows during the week, and I'll be back next week. Have a good evening. Have a good week. And thanks very much for spending some time with me. This is Martin North from Digital Finance Analytics, signing off. We'll see you next time. Cheerio.